This is Andrew Stotz of Stotz Investment Research, and today's topic is interest rates down, stocks up, and vice versa. So let's look at this chart before I go into the bullets I want to highlight. The first thing is that let's look at the right-hand scale. And what you're going to see is that scale goes from 100 to 900. And that's the stock market. That's the red line. And we can see that if we go back to 1987 and we rebase the U.S. stock market at 100, we can see that it's gone up to almost 900 over that period of time till 2017. Now, let's also look at the left-hand scale, and you can see that that's a percentage from 0 up to 12%. And we'll look at the blue line first, and that is government long-term bond rates, which has fallen from about 8% down to about 3% currently. Of course, when the government's they want to bring down that long-term rate, the way they do it is with the short-term rate. So let's look at the short-term rate, which is the yellow line. And we can see that the yellow line is much more volatile and goes through big reductions and then rises. That's all controlled by the Fed in hopes that they're going to control that blue line. But overall, you can see from the blue line, it's been years and decades of falling interest rates. The second thing, the last thing I want you to see on this chart is I put in some lines, some vertical lines. They're gray. And the first one, you can see I've put in just after March 1992. And this basically is the point that interest rates started to, had been at their bottom for a while and we're going to start to rise. And after that, we saw a stock market boom. And then again, after March 2002, we can see that the yellow line had reached its bottom. That was the government, the Fed, keeping interest rates super low for a while. And what happened was the red line boomed again, the stock market boomed. And then let's look at the final gray line, which was just after about March 07. And what we can see from that one is that the zero interest rate policy set the U.S. stock market on a tear. So there's a very clear relationship. So let's see what we got here. First is that since 1987, short-term interest rates fell by 91%, or falling to 0.5. Right now, that's where they are. Next thing was that the long-term rate fell 62%, and that fell down to 3% where it currently is. Now, falling interest rates meant stocks up. During the whole period, stocks were up by about 745% because of this long fall in interest rates, along with other things. Now, interest rate bottoms drive market rallies, and that's the point that we show with the gray lines. And that's what we've had, is a tremendous market rally, and now the rally is probably going to be over. Whether it's over in 3 months, 6 months, 12 months is a question. But if the government raises interest rates, the Fed is raising the rates, which they are starting to do and probably are going to continue to do, what's going to happen is eventually it's going to hit the U.S. stock market if the patterns that we've seen in the past continue in the future. Have a great day.